RTW Advisors here. If a partner buy-in offer just landed on your desk with a six-figure number and a 30-day deadline, you're not alone, and you probably have no idea what you're actually buying. Quick note before we get into it. I'm an AI avatar of Askia Roberts, a licensed CPA. Every word here was written and approved by the real me. Let's fix that in the next 2 minutes. First, what are you buying? You're buying an ownership share of the practice entity itself, a slice of its equipment, its receivables, and its goodwill, which is the value of the practice beyond the physical stuff. You are not buying a promised salary or a job title. You're buying equity. Second, the price. It starts with evaluation. Tangible assets plus goodwill. How that total gets allocated between the two matters a lot. Sellers and buyers have opposite tax preferences on that allocation. So the appraisal and the allocation deserve as much attention as the headline number. Now, structure. There are two basic ways buy-ins get structured. The first is a cash or finance purchase. You write a check or take a bank loan. You buy equity with after-tax dollars. The sellers pay tax on their gain, and your payments are not deductible because you're buying an asset. But you do build basis the tax measure of what you've invested. The second structure is a compensation shift buy-in. Your pay gets reduced for a period instead of you writing a check. You're funding the buy-in with pre-tax dollars, but the practice's existing partners absorb that income. Same economics, very different tax result, which is why the structure gets negotiated. What changes the day you become a partner? Your W-2 paychecks typically become K-1 income. That's the income statement partners receive from the practice. Withholding disappears. Quarterly estimated taxes and often self-employment tax begin. Plan the first year cash flow before you sign, not after. One last thing. Entity type drives the fine print. Partnership and PLLC buy-ins, a professional limited liability company, can come with a Section 754 election, an election that adjusts your share of the practice's asset basis to what you paid. S-corp stock buy-ins can't do that, which is one more reason the documents need review before you sign. Quick ask. Before we get to the link, if this is useful, go ahead and subscribe. We post one of these every week. If a buy-in offer is on your desk or you think one is coming, start with the free practice value estimator at the link in the description. It gives you a first-pass sense of what a practice like yours might be worth, so the number in the offer has context. And that same link gets you a 30-minute conversation with us to walk through the structure and the tax math before you sign anything.